All right, good afternoon. The next Planet MicroCap presentation is Creative Realities. I want to introduce Rick Mills.
Hi, folks. 4 o'clock in the afternoon. You only got a couple more to go. I will be cognizant of that. We'll get through this fast and get to Q&A. So, obviously, the slide that says, don't believe a word I say, and the next slide that says, don't believe any of the math that we show you, right? Non-GAAP. What do we do? What is Creative Realities, or CRI as we call it? Our business, we connect guests and shoppers to the places they love through digital experiences. Pretty simple. Think digital screens on walls somewhere. Just a little bit about our ethos as a company. These are, our purpose is digital signage solutions that connect brands and people. Our vision, a trusted advisor and supplier of these digital solutions at scale. And then most of those are all our, what we would call our company motto and how we think: nimble-minded, be respectful, helps first, do the right thing, be passionate, expects excellence. So those are all the guiding principles that drive all the folks at CRI. Sources of revenue. We generate revenue from 3 sources. Number one, we actually sell the screen. We do not own it. We don't maintain ownership of it. We sell it to the end user, the customer. Number 2, we provide all the services around that screen during the life of that screen, and we get paid to do that. But our primary focus is taking that screen, getting it on a wall, and getting it connected to our software in the cloud. We are a SaaS business. And the third revenue is recurring SaaS. Our value prop is we are a SaaS company focused on increasing the number of subscription devices. That's what we live and die for. Target market or ideal customer profile: retail, quick serve restaurants, C-stores, financial, some family entertainment, stadium and arena. We only talk to enterprise customers. If there's a small customer that maybe has 40 screens somewhere, that's not the customer for us. When the customer has 4,000 screens, that's when we step in. And you'll see that when you see our customer profiles. Okay. A little bit of the history. This company was started many years ago. And in 2014, merged my company in. Actually, my company was called Connexus World. I merged it into Creative Realities, took control of the entity, cleaned it up, uplifted to NASDAQ in 2018, did our first acquisition, and then did another acquisition in 2021. So we've grown organic growth and also some acquisition. Some of our strategic partnerships, those are the products we use. We do not build our own products. Our product is the software that we own in the cloud. We build that. But the screen, we use Samsung, we might use LG, we use Bright Sign players, we use Legrand mounts, etc. So really 4 key suppliers up on the board. How are we doing? Well, we manage many of the largest signage deployments in North America. 4 out of the 10 largest networks in the US run on our gear. Okay. Invitus, which is a firm in Germany, they're kind of the global experts and keep a finger on the pulse of the global signage industry. They would tell you we are the 4th largest globally in number of screens that we manage. Sampling of our clients. How many folks here have been in a Best Buy? Got it. We do every Best Buy in America, the TV wall. How many people been in a Verizon store? Verizon today is about 56,000 screens for us. We do every Chanel store in America. We do every Macy's store in America. 7-Eleven, C-store, convenient chain, everybody's familiar with it. Every business day in America, today included, I install 1 to 3 new 7-Elevens every single day. I have for the last 5 years. I will for the next 10. Speedway, Chevron bought them. Stadium and arena, I got a separate slide. We'll talk about that. Some of the others, Cedar Fair and Six Flags just merged, became the 3rd largest entertainment amusement company. Panera, Black Rifle Coffee, Freddy's. We put out a press release yesterday where we signed a new client, 1,000 location QSR located in the Midwest, etc. So as you can tell, these are all enterprise first grade credit customers. That's a breakout of our QSR and C-store customers. Freddy's, Panera Bread, 7 Brew, The Human Being, all rapid growing coffee companies. We do a number of stadiums with Levy's, and we'll talk about that. Stadium and arena. Today we do about 70 stadium and arenas across America. Some of those, Cowboys Stadium or AT&T Stadium in Dallas, Texas, our software runs every screen in the building except for the Jumbotron. Sacramento Kings, same thing. We just redid the Target Center last year. Our software runs every screen in the building. Some of these, like Ford Field, is just the menu boards. So if you think about a stadium and an arena, a stadium will typically have about 10 food concepts. You know, they got the pizza place, and then they got the burger place, and then the barbecue, and then the chicken finger place, right? So every year I have a team of folks that we get paid to update all these menus. So just in this area alone, we do about 650 unique menu concept designs every year. That's a picture of one. Black Rifle Coffee. We redesigned their menu. They had one drink. It was called the Hero line of drinks. Sales increase after we went digital and put the sign in was 1,007% increase for the one drink. The one coffee ROI'd paid for the entire digital infrastructure we put in under 120 days. There's not many ROIs that are 120 days in business. Panera Bread, so a number of Paneras. 7-Eleven, a lot of people don't realize it. 7-Eleven has 1,600 restaurants. They have 14 food concepts and 1,600 restaurants buried inside of the 7-Elevens across America. This particular one has 2. They got the Parlor Pizza and then the Roost Chicken. So 2 food concepts inside this one particular 7-Eleven. Today, the network at 7-Eleven is about 17,000 screens. Every day, we add about 10 screens every single day. Verizon, this was a particular thing we did for Verizon where it was touchless back in COVID. Nobody wanted to touch a phone. Nobody wanted to touch a thing. But that's a picture of Verizon. This is a little bit about our tech stack. We have 4 platforms. The first platform on the left is Clarity. That is purpose-built for food and C-store. Every C-store and every food experience we have runs on our Clarity platform. The second one is ReflectView, which is a purpose-built CMS or content management system, and that is built for just pure retail. Think Best Buy, think Verizon, think the medical networks, think Macy's. They all run on ReflectView. AdLogic is an ad serving component that sits on top of our CMS. And it injects ads because some of these, particularly, think you're walking through our theme park customer. Our theme park customer, Six Flags, we have about 8,000 screens spread throughout all their parks. And so they sell advertising. And our AdLogic is delivers those ads to those screens. Today, we serve up about 50 million ads a day, every single day. It's over 1 billion a month. CPM Plus is our newest product that sits on top of AdLogic. And that really is for a full, complete retail media network that somebody like a retailer, we're talking to a bunch of the automotive retailers, right? Like Riley's Automotive. They got 3,000 locations and they want to put in a retail media network. And that might be 15 screens inside every store, but then they sell ads on it. And instead of becoming an expense, it becomes a profit center. Oh, by the way, retail media networks, they're huge profit centers. 25% of Walmart's net profit last year, 25% came from their retail media network. Target was 30%. 30% of all net profits came from one thing, their retail media network. In order to power a retail media network, you got to have screens and you got to have CPM Plus software. So every retailer is looking at a retail media network today. This just talks a little bit about its state-of-the-art functionality. It allows to sell ads in the private marketplaces at reduced rates. Disintermediates the unnecessary third-party platforms. So today, some of these retailers are using third-party platforms that take 30% of the ad spend. So if they're generating 100 million on the retail media network and they're using third-party, they're giving away 30 million. With our software stack, it gets down to less than 10. We do have a content capability. So we design a lot of content. A lot of the customers have us manage their content. Like 7-Eleven, they don't log in their system. We log in every day. If the Slurpee or Slushy or whatever is on sale in Texas today for 99 cents, it's because my team changed the price, right? If there's a new burger, we create the look and feel, whatever the content is. So I have 15 people full-time that do nothing but manage content every single day. And the marketplace we're in today, these are the growth drivers. I don't have to go in and tell a customer, hey, let me explain why you should take down that poster and put up a digital screen. I don't have to do that. They are all under pressure. Retail is under pressure. How do I get more profitability? How do I put in a retail media network so I can extract more value from my suppliers, right? Everybody says, I want an improved customer experience. We're in this generation today that values experiences over things, right? So you've got a lot of people want to improve the customer experience. We talked about monetization. And also, I don't want to put up just a bunch of digital screens anymore. I want to put up a bunch of digital screens and I want to monetize them so that I get an ROI on it and I get income. It's no longer an expense for my business. It is now a profit center. This is what differentiates us, okay? So we're at 50 plus million in revenue, give or take, okay? Which makes us, and again, we're already the 4th largest globally. We're one of the top 3 or 4 in America. Most of our competition is very small. This is a very fragmented market. There's 300 to 400 competitors. 90% of them look like the following. They're mom and pop shops, right? They've got 20 to 40 employees. They have 20 customers and they're all regional in nature. And that's it. And they have no idea how to scale. How would I go do a Macy's all across America? Well, as you can see, all of my customers are all across America. We're built for enterprise scale. And so we tend to stack up very well against the competitor. When we go into an RFP situation, we typically win about 70% of the time. 6-point value creation plan. I got to put my glasses on to read this right here. Record annual revenue of 50.8 million in 2024, despite we had an accounting change that the public accounting came and made us change one recognition that took 4 million of revenue away from us, so we'd have posted 55 million. We said we would do a 10% EBITDA, adjusted EBITDA target. We achieved 11.2. We think this year we'll do adjusted EBIT of about 15% in 2025. We grew the ARR, or that is pure SaaS revenue, right? Our ARR, annual recurring revenue, we grew from 12 million in 2021 to 16.3. Okay, it's a 16.5% CAGR. ARR translates to EBITDA and free cash flow. And we as a company are right on the inflection point. Every dollar above our current fixed cost goes to the bottom line at a higher recurring or at a higher percentage. A very disciplined approach to reducing debt and financial leverage. You can see the different points on the screen. Net debt moved from 19 million year-end 2022 to 10.1 million Q3 2024. Today it stands at 12.1. Leverage ratio, reduced it from net debt leverage ratio from 5.0 to under 2. It stands at 2.4. We had it as low as 1.4. Okay. In Q1 of this year, in February, we released the settlement of a contingent liability. That was a potential balance sheet payment that we could have potentially had to made to an acquisition. Generally, all the analysts figured it as a $13 million piece of debt. That's how they looked at it. We settled that for $7 million. So we had a good guy pick up $6 million in below the line earnings increase in Q1 alone. I talked a new programmatic ad platform. And then the value creation puts company in a position for accretive M&A. We are on the hunt for a target, and we're going to do that with mostly debt. We will not issue equity at this tremendous discount. Today, for all of you folks who understand the multiples of SaaS software companies, right? Some people would say they're 5 times the ARR, they're 6 times, they're 7 times. Today, my market cap for the entire company is less than 1 times my ARR. Today, as we sit, my market cap's 15 million. My ARR is 16.7. If I wanted to sell it tomorrow for 80 million, I'd sell it. So to say that we believe we're undervalued, of course, every CEO says here and says the same thing. We think in this case it's real. That's our improving debt leverage ratio. It has climbed a little bit in Q1. We told the market in November that we were going to have a soft Q4 and a soft Q1. And we did. A couple of projects got delayed by customers. But so be it. We're back on track and believe that we are very comfortable with the numbers that the consensus of our analyst has out in the marketplace. We have not given guidance on a quarterly basis. We're not reaffirming guidance. All we're saying is we're comfortable with the analyst consensus on revenue for 2025. Then here's where we talk about a little bit more, go into more detail about the accretive acquisitions. The industry research has identified 1,200 companies, okay? And again, the characteristics down there, they're focused on just 1 or 2 verticals. They have minimal technical depth, and they lack what we call strategic chops to scale all across America, okay? We bring them, we acquire them. That's what it results in. Reduced overhead, it drives scale, it increases profitability and EBITDA, and ultimately an uplift in valuation. Our plan for the next 12 months, we expect to complete an acquisition and scale to 100 million in revenue. I am laser focused on that. I want to become the go-to acquirer in the industry. See, at 100 million, this business, the EBITDA exceeds 25%. So I'm generating 25 million EBITDA, and I'll be generating 19 to 21 million in free cash flow. When you generate 19 to 21 million in free cash flow, this becomes an acquisition machine. Because I can take 19 million of that free cash flow, mirror that with debt, and do acquisitions every year and roll up the small competitors, get rid of all their SG&A and migrate them to our platform. We believe that we will grow from 100 million to 300 million in the same time period it took me to get from 30 million to 100, because of the way we've built the business and the scalability and the leverage point we are at right now. Our ultimate goal is to get to 1 million endpoints generating high margin SaaS. When we get to 1 million endpoints, that's $100 million a year in SaaS revenue alone. Questions? We've got about 9 minutes left. I told you I'd get through it quickly. Yes, sir. That is correct. Yeah, because we've been building a platform company and it's all about building the platform and it keeps growing. And so if you go look at our Q3, see, it shows the difference in scale. You had 3 million in revenue, which we did in Q3, 2 million of profitability dropped to the bottom line. I don't need any more fixed cost. I don't need any more tech. All we're looking for is customers to put them on top. That's why we're at the inflection point. But yeah, it's been very hard to assemble this platform company. You know, by the way, we got hit by SaaS, right? Or by COVID, I'm sorry, SaaS. COVID hit us hard. Revenue declined 47% in 8 days, right? And that we think that's a one-time thing. We don't think that's coming back around. So in 4 years, we took the company from effectively, we were at 33 million, we went to 17, and in 4 years, we've gone from 17 to 55, or 50 plus, whatever. So we believe now is the time. What else? Generally, the customer, always. The customer owns the equipment. Yeah, we are not in the screen owning business. And that's a great question. Let me just clarify. We run a lot of networks for customers. We own 0 networks. We don't own the network. We don't own the hardware. They own it. But it's our software that they rent from us, SaaS, and then they pay us to service and manage and run it. Okay? Yes, sir. Yes, we believe this year, we said this year we will exit the year at a 15% run rate. Composite adjusted EBITDA what might be in the 11 to 12 range. Okay? Yes. Yes. There's a company called StrataCash. They are truly the 800-pound gorilla because they sold McDonald's 10 years ago. So they have McDonald's as a client. So by the mere nature of just that one QSR, they're number one in the US. There's another company. The other 2 companies that I compete against are both private equity backed. They've put 250 million into those companies. We've put 16 in, and I'm almost the same size. Much more efficient use of capital. Okay. And last but not least, we are at booth 319. So certainly come by and see us. Love to talk to you. We've got a QR code there. You can scan it, take you right to presentations, more information on the company. With that, thank you all very much.